Hi, this is Tom Essaye from Money and Markets TV. If you haven't been paying attention to the global economic news and just looked at the recent performance of the U.S. stock market, you might think that we're in the midst of a bull market. But contrarian investors have to look beyond what the markets are doing and take in the full economic picture. So it's clear to me that the rally is due to optimism that European officials are committed to saving the euro. Investors believe that the ECB, along with the Federal Reserve and other central banks, will print more money to get the global economy growing again. But things are never that simple. More quantitative easing won't be enough to pull us out of this kind of deep funk. Europe is already in recession. China is slowing. Japan's most recent GDP numbers disappointed. And despite all the optimism, the U.S. economy grew by just 1.5% in the second quarter. Normally, those kinds of numbers would spark a sell-off in the S&P 500, not an 11% gain year to date. Yes, things in Europe are not as dire as they seemed earlier this year when Greece was on the verge of default and people were talking about a total collapse of the Eurozone. But despite the improvement, the global economy is still in deep trouble. Consumer demand remains weak. Many countries, including the U.S., have huge debt loads to address. And the emerging markets are no longer the engine of growth they have been over the last decade. So let's look at the economic environment for what it is, not what we hope it could be. We have slow growth, high unemployment, and stagnant wage growth. In short, we have the same type of economy we've been dealing with for the past few years. The next step is to ask yourself what sectors of the market would perform well in this type of environment. Well, in uncertain times, individuals are more budget conscious and less likely to extend themselves. They want to make their dollar go further, so they opt for less expensive retail stores such as Dollar General and less expensive restaurants like McDonald's. That's the reason consumer staples have done so well over the past couple of years, and it's why I think they'll continue to do well. You can get exposure to the entire sector with the Consumer Staples Select Sector SPDR, symbol XLP. This ETF has a strong mix of some of the largest names in the industry, and it pays a nice 2.5% dividend yield, a huge plus in a zero interest rate environment. It's important to remember that just because the stock market is rising in the short term, it doesn't mean the skies have cleared and it's a sign to take on a lot of investment risk. Keep in mind the economy is still weak and there remains a lot of risk to a recovery, not just globally, but here in the U.S. too. I'm Tom Essaye from Money and Markets TV, and thanks for watching.